All right, this is the 11th video of the Definitely series, and it's the first video of valuations, and we're going to be talking about comparable company analysis, sometimes referred to as public comps. And here's a really basic example. I mean, we kind of did one before, but here's one that is pretty easy and intuitive to understand. Well, let's say that I'm trying to sell my house, right? And in my neighborhood, there have been 5 sales, and all of those sales have been in between $900,000 and $1 million, right? Well, if I'm going to list my house, it's probably going to be somewhere pretty close to $900,000 to $1 million, assuming that my house is relatively similar to those in my neighborhood. And the reason why we can assume that is, I mean, the location is the exact same. The houses are probably relatively similar, right? The risk in terms of where the house might be located is probably relatively similar. The school districts might be the same, whatever the case is, right? Overall, these companies, these houses are relatively similar. So let's look at an example with companies, right? A good example is Uber and Lyft. Well, if we know that Lyft has revenue of $100 billion, and we know that it is valued at, meaning its enterprise value is $1 trillion, and we also know that the revenue for Uber is $150 billion. If we're trying to value Uber, how should it be valued? Well, we know that Lyft is trading at 10 times, right? Meaning that the enterprise value is equivalent to 10 times its revenue. So it would probably be pretty fair to assume that the enterprise value of Uber is also 10 times. So giving it a valuation of $1.5 trillion. But why can we assume that? Well, we can assume that because we have really similar companies here. Uber and Lyft are relatively similar. They're pretty similar in terms of what they do. They're similar in kind of like the industry that they're in. All right, so let's write industry. They're similar in size, right? They're similar in like their growth prospects. They're similar in probably the margins that they have, right? Their profit margins, probably similar in terms of their how risky each company is. They're probably relatively similar. I know they're similar in probably location, right? So all of those lead to these companies being relatively similar, so we can make the assumption that, okay, if one is trading at 10 times, the other should also be trading at 10 times, right? Of course, it's not a perfect like comparison, but it gives us a kind of a place to start, right? And something else to kind of keep in mind is that the public comps way of valuing something has a lot of different like pros and cons. So we'll kind of run through a couple of those so that it's kind of clear what the use case is for public comps. Let's mark it like this. We'll put pros on this side and we'll put cons on this side. So what are some pros of this? Well, like you could probably see, this was really fast, right? It's pretty fast to run public comps. If you have all the information available, you're able to see really, really quickly whether something is undervalued or overvalued. And essentially what that means is that if we think that Uber's value should be, so it should be 1,500 based on our analysis, and currently it is 1,000. Well, that probably means that there is $500 worth of an upside here. Similarly, if it was currently 2000, that means that it's probably overvalued by 500, meaning that there's a $500 downside, right? So if it's undervalued, that means it has an upside. If it's overvalued, it means it has a downside, right? Just so that we're kind of clear on that. So public comps are really, really fast. Another thing is that they are easy, and they're easy in two different ways, right? They're easy, number one, in actually running the public comps. It's really easy to do that, but they're also really easy to explain, right? It's very easy to say that, we believe that Uber is valued at this much because Lyft is valued at this much, right? And they're relatively similar companies. The only assumption that you need to make there is that they're relatively similar companies. And lastly, and this is kind of a double-edged sword, so I'll put it in both the pros and the cons, but it's market-based. So essentially, what does market-based mean? It means that all of the information that's going into the prices in the market is also priced into our public comps, right? So if the market thinks Lyft is worth a certain dollar amount, and we make that assumption and apply it to Uber, well, at the end of the day, we're essentially aggregating all the research and all the time that's gone into pricing in Lyft, and just kind of like applying that really directly to Uber. So that's one of the pros, I would say. The con on the market based side is that imagine that you used public comps to value banks in 2008 or 2007, right? Well, you would say that, oh, this bank is trading at this, so because of that, this bank should trade at this, right? So one bank is trading at 10 times, oh, the other bank should also trade at 10 times. Well, what happens when one major bank fails, right? Or what happens when the entire industry as a whole is propped up artificially based on something, essentially meaning that we're in a bubble, right? I mean, so the value of everything in that industry is artificially propped up. Well, then all of our public comps are going to be artificially pumped up too. They're all going to be wrong because the entire market is in a bubble, right? So that's kind of the double-edged sword on the market-based. The other thing that comes to mind is that this is relatively hard to find, right? I mean, I gave a really easy example of Uber and Lyft. They're really similar companies, right? But if you have a really unique company, a really unique product, well, how are you going to use public comps to value that? You probably couldn't, right? Because there isn't a company that is similar in terms of its industry, its size, its growth, its location, its risk, its margins. You're going to be hard pressed to find that. So that's another kind of con of public comps. And then lastly, this is just almost like a side point, but it's not really a rigorous form of analysis, right? I mean, it ties in with the first 2 points, but at the end of the day, it's you're just running a couple of numbers and plugging them in, right? It's not necessarily a very defensible position, especially if a client like gives you like some amount of pushback on it. So because of that, yeah, there's a number of cons, but then again, I mean, this is fast, it's easy, it's based on the market, so it's still a really solid way to look at valuations. And you might get asked in your investment banking coffee chats, investment banking interviews, to basically describe what a public comp is. That's probably the most common question that I would anticipate you seeing. And the second most common question would be, what are the pros and cons of a public comp, right? And then lastly, how does this rank in terms of the valuations in relation to other valuation techniques, right? Will this lead to a higher valuation or a lower valuation based on the other valuation methodologies? And I'll answer that question after I've gone through all the rest of them. But for the most part, I mean, you guys now know what public comps are, the pros and cons of them, and kind of the intuition behind it. So you should be good for any questions around public comps. So let's hop into The next one, which is precedent transactions.